Okay, we're going to talk about depreciation and how it works. We're going to start with normal depreciation, which everybody gets the benefit of. And then we're also going to talk about cost segregation, bonus depreciation, accelerated depreciation, which certain people can take advantage of, and it really, really boosts up ROIs inside of real estate. But first, normal depreciation. I'm going to use a scenario of you buy a house and the purchase price is $300,000. Okay? First and foremost, we have to subtract the value of the land because you don't get to depreciate dirt, right? You get to depreciate the house because there's a lifespan of the contents and what's used to construct the house. So we're going to say the land is worth $25K. So we have to subtract those. So our starting basis is $275,000, and that's what we get to depreciate. The IRS says that you get to depreciate over 27 and a half years. So this is easy math here because we're going to divide that by 27. And so each year we get a $10,000 depreciation benefit. Now, how does that help us? How does it produce ROI for us inside of our portfolio? Well, if you cash flow $300 a month, and that's $3,600 a year, and let's say you pay down $200 a month in principal, which is $2,400 a year, that's $6,000 of taxable gain because you get to deduct the interest portion of a mortgage payment and the property taxes and insurance and repairs and maintenance and all those things, but you don't get to deduct the principal part of your mortgage payment. So you have cash flow plus principal reduction equals profit per the IRS, okay? So if we have $6,000 of profit, you know, if we pay 30% in Fed, state, and just total taxes, you know, that would cost us $1,800. And we have $4,200 left over, right? For our operations or our life or whatever we want to do with it. Well, because we have $10,000 of depreciation, we don't have to pay any taxes on that $6,000. We still have $4,000 left that then can go to offset $4,000 of other income, okay? So now we're saving, you know, again, if we're 30% taxes, we're saving basically $3,000. And you compound that year over year over year over year, especially if you go and invest that $3,000 and make an 8, 10, whatever percent return on it, it becomes pretty significant over time, okay? Everybody gets this. Your CPAs, when they file your taxes, they should be doing this for you. If you use TurboTax and file on your own, when you put in real estate rental properties, this should automatically happen. And everybody gets to benefit from that. Now, I'm going to show you what cost segregation is and how that works. Kind of a brief explanation is you have an investment property and not everything has a 27 and a half year lifespan, right? Flooring, maybe the lifespan is 5 years if it's carpet. Maybe it's 10 years if it's LVP. Light fixtures, paint, plumbing fixtures. Most of those don't have 27 and a half years. And so we want to accelerate the depreciation on those items. Now the foundation, we don't get to accelerate that, right? It's cement, it's not going anywhere. So what happens is we hire a company that goes in and does an analysis. And they produce a 20, 30 page report that typically is an addendum to your actual tax returns that goes in and breaks down the lifespan of all of this. Long story short, what we end up getting, we still have that starting point of $275,000. We get on average about 35% of that number in year one depreciation. So let's say that's $90,000. I don't know what it is exactly, but I think that's pretty close. So let's say it's $90,000. So year one, we get $90,000 instead of 10. Well, if we pay 30% in taxes, that just means we save $27K, a significant number. That might be a third of your down payment to buy the property. So it's like you're getting a third off on your down payment technically, right? And then what happens? Well, we're 90,000 left. So now we're at 185. And then you divide that by 26 and a half years. And then you get that amount, I don't know the exact number, let's call it $7,800 each year for 26 years. right? It goes back to this schedule on normal depreciation, but we took off a year and then you get the rest of it there, but you front load it here. When you look at the wealthy, you look at Trump, why didn't he pay taxes? All these different things. This is one of the biggest levers they have that they can pull. I utilize it. The differences is, why doesn't everybody do this? It's because for a normal person, if you're a W-2 employee, you trade 40-ish hours a week for your income and you invest in real estate on the side, this can only offset passive income. Well, most people don't have significant enough passive income. Most of their income is active. And so it doesn't really benefit them. So they just do the normal depreciation. I'm a real estate professional. And as a real estate professional, my real estate income, my investment income is active income. And so when I do this, I get to offset my active income, my normal income. And so I get the full benefit. I have clients who have a non-working spouse who will go get her real estate license and become a real estate professional. She's a member of the LLC that owns the rental properties. Now that's active for her as a real estate professional. She can check the box as a real estate professional, and then they can benefit that on the cost segregation on their joint tax return. So there's ways to get creative or get aggressive and strategize on how to do it. Of course, consult your CPA. I'm not a CPA, and they'll be able to guide you in the right direction. But if there is a way that you can do this, it's phenomenal and it's powerful and it just turbocharges your ROIs. Otherwise, this is how normal depreciation is working for your benefit inside of your real estate portfolio.